You might feel average is safe, but what if average is a financial emergency? The median full-time worker sits in the middle of the pack. Half earn more, half earn less. That's just over $1,000 a week, about 52 grand a year, or roughly $26 an hour. Yet most people only take home around $35,000 to $40,000 after taxes. Now layer in $9,000 in credit card debt at 15 to 25% interest. Who's really getting paid here? Not you. Stay with me. We're going to strip down the headline number down to what actually hits your account and why it still feels tight, even when $52,000 sounds solid. Let's talk about the paycheck illusion. On paper, $52,000 sits neatly in the middle of the pack, but what lands in your account tells a different story once the first deductions hit. Median full-time pay sits around $1,000 a week, or roughly $52K a year. That's the headline. But paychecks arrive after federal income taxes, state taxes, Social Security, and Medicare take their share. By the time those are taken, the same worker often sees only $35,000 to $40,000 in net pay for the year. Compared to the $52,000 headline, that doesn't seem like quite as much money. And that gap between what you earn and what you keep shapes nearly every decision you make with money. Run it monthly. On paper, $52K is about $4,333 a month before deductions. After payroll taxes, many land near $3,000 to $3,400. That's the cash you actually have to work with for everything else. It feels tighter not because you did something wrong, but because the basic slices get taken off the top, automatically. Where you live widens the gap. Effective state income tax rates vary. Some states take closer to zero, while others add several percentage points on top of federal taxes. That difference can shift your take-home by a few $100s each month. Two people with the same salary can experience very different realities just by crossing state lines. There's also the confusion between individual and household numbers. A single renter making the median might take home around $3,000 a month after payroll deductions. Compare that with a two-income household. Double the gross can seem like plenty, but add a larger rental, higher transportation costs, and family expenses, and the margin can still feel thin. Household income headlines can lure you into commitments that your single paycheck cannot support on its own. Here's a simple example of where the cash goes before you notice. After taxes and payroll deductions, your net might hit your account around $3,100. Rent or mortgage pulls the first big chunk. Utilities, phone, and internet are next. Then health costs, transportation, groceries, and minimum debt payments. By the time subscriptions and small recurring charges clear, you're left reacting, not planning. The core issue isn't coffee runs. It's fixed costs that renew every month without asking. When your baseline income is already trimmed from $52,000 to something closer to $35,000 to $40,000, every automatic bill has a bigger impact than it looks like on paper. For the median earner, that often translates to roughly $3,000 a month to cover essentials and anything else you want to do. So the illusion isn't that you're spending wildly, it's that the headline pay hides how little is truly flexible. Once you see the real number, the next question is obvious. Where does it go the moment it arrives? Let's open the ledger and follow the cash. Where the money disappears isn't a mystery, it's a repeating pattern. If you tracked every dollar for 30 days, how much would actually survive past the essentials? The average household spends around $5,577 a month. And that's after-tax money leaving your checking account. Rent or mortgage, car costs, groceries, insurance, utilities, and everything in between. This is the real burn rate most people live with, not a theoretical budget. Now line that up against what hits a typical paycheck, and the gap starts to show before week 3. Let's put the numbers side by side. A median earner's net pay often lands close to $3,000 a month after payroll deductions. Against $5,577 in average spending, there's a clear mismatch. Even if a partner's income helps, the core pattern holds. The fixed bills set the pace. Housing runs about $1,885 a month on average. In many major cities, think San Francisco or New York, that $1,800 number might only get you a closet with a window, which means the average is even harder to hit in dense urban areas. Transportation adds roughly $913 a month, about $11,000 a year when you account for car payments, insurance, gas, and maintenance. Food clocks in near $691, and spending less than $700 a month often means mastering the art of living on ramen noodles and peanut butter sandwiches. Right there, housing plus transport alone can surpass half of a single median take-home and consume a large chunk of a two-earner setup. Add utilities, health costs, internet, phone, and you've already narrowed the month. Transportation hides more than a car payment. Commuting distance changes fuel, maintenance, and depreciation. A 20-mile daily commute can add dozens of dollars a week in gas, plus faster tire wear and more frequent oil changes. The vehicle itself matters. A newer financed SUV with comprehensive insurance can tack on hundreds monthly compared to a paid-off sedan with liability coverage. Those choices sit on the fixed side of your budget and they repeat 12 times a year. That's how you get to roughly $11,000 annually without noticing. Every category piles on. 2 roommates show how decisions compound. Same salary, different paths. One rents a 1-bedroom solo, drives a financed SUV, and pays for covered parking. Their monthly outflow balloons with the loan, full coverage premiums, higher fuel, and a larger rent. The other house hacks a 2-bedroom, shares utilities, and drives a paid-off used car. Their rent is lower, utilities split, insurance cheap, and gas spend lighter. Same income, opposite cash positions by day 20. Small trims add up faster than you expect when you hit recurring categories. Cut $150 a month from housing by moving to a slightly smaller place or negotiating at renewal. Trim $150 from transportation by swapping a high-payment vehicle for a reliable used one and adjusting insurance coverage. Reduce $150 from food by shifting a portion of meals to planned bulk cooking. That's $450 a month back. Over a year, you've freed $5,400 to invest instead of letting it leak into non-essentials. At that pace, you set your investing floor before raises show up. Here's the quiet truth. Fixed costs cap your investing ceiling before debt even enters the room. Most people end the month with less than a few $100s because core expenses don't match income. And when the essentials win every time, the shortfall doesn't disappear. It slides onto a card where someone else starts collecting. Which brings us to the main siphon, the interest machine. Who profits when the average household carries over $9,000 on credit cards? The bank. Not because you swipe, but because balances linger. The typical APR floats between 15 and 25%, and that spread decides whether a one-time purchase becomes a long-term bill. Let's break it down so it's clear why the math tilts against you when you only pay the minimum. A $9,000 balance at a 20% APR costs about $1,800 in interest over a year if you barely chip the principal. That's $1,800 thrown away to make credit card companies rich. Money that never buys groceries, never pays rent, never builds your wealth. At $150 a month, you can see how quickly interest alone devours cash flow that could have gone into savings. When you treat the card as an emergency relief valve, the interest rate turns a short-term convenience into a multi-year habit. Minimum payments keep the account current but stall progress. They're designed to be small relative to the balance, so interest rebuilds as fast as you knock it down. You feel like you're complying, yet the principal barely moves. Over time, every purchase you don't pay off within the grace period turns into a slow drip that compounds against you. Compounding works both ways. When you invest, compounding rewards patience. With debt, compounding punishes delay. Paying down a 20% APR balance delivers a guaranteed return equal to that rate. A result most investments can't match reliably. There's no point in earning 7% in the stock market if you're simultaneously paying 20% on credit card debt. Every dollar you put toward the principal stops future interest from accruing, which frees up the next dollar even faster. Here's a simple contrast. Add $300 extra each month on top of the minimum, and you can clear around $9,000 in roughly 3 years, depending on fees and rate changes. Stick with minimums, and the timeline can drag past a decade, especially if you keep swiping. The gap isn't just years, it's thousands of dollars that could have been redirected into your goals. And what sits behind those balances? Not meaningful assets. It's often stuff sitting in closets gathering dust. Impulse buys in apparel and electronics, dining out, travel upgrades, and seasonal bursts like holidays or back to school. Those costs feel manageable at checkout, then roll over at 20% when the statement arrives. Cutting this balance is the fastest way to move from average to ahead. The return from eliminating 20% interest is immediate and certain, while market returns fluctuate. Kill the 20% APR first. It beats almost any realistic investment return. Once you stop feeding the interest machine, you reclaim cash flow for savings and investing. And that cash flow matters for the next question. When it's finally time to live on what you've built, how far does the typical balance actually stretch month to month? Let's talk about the gap that shows up when paychecks stop. Retirement's silent shortfall. What does the typical 65-year-old savings actually buy per month, without rosy assumptions? Let's lay out the numbers clearly. The median retirement balance across all ages hovers near $65,000. For people 65 and older, it's roughly $88,000. And about 1 in 4 adults has no retirement account at all. which means they're entirely dependent on Social Security. Those figures aren't outliers, they're the middle of the pack. Now, translate that into spending power instead of a headline balance. Use a simple rule like a 4% annual withdrawal. Apply it to $88,000 and you get about $3,500 per year. That's under $300 a month. Not a typo. That's the cash flow someone can reasonably pull without risking a fast drawdown, assuming normal market ups and downs. It's a stark number because balances look big in isolation, but monthly needs demand consistency. And $300 a month wouldn't even cover basic groceries, utilities, and healthcare, even if you own your home outright. Social Security plugs part of the gap, but it isn't a fixed promise at one number. The average benefit hovers around $1,550 per month. Yeah, your actual check depends on lifetime earnings, years worked, and the age you claim. Higher earners can see more, lower earners less. Claim early and the benefit shrinks. Delay and it grows. That variability makes planning with precision tricky when your savings don't add much cushion. For the 1 in 4 with no savings at all, that benefit is the entire plan. Here's where timing bites. Most people stop working around 61, while full retirement age for standard benefits is closer to 67. Many reach 65 and can expect to live another 19 to 21 years. That's a multi-decade funding gap that should keep you up at night if you're only relying on a small balance. If your savings sit near $88,000 and you hope to draw even a modest $24,000 per year to bridge those years, the math doesn't pencil out. You'd need about $144,000 just for that bridge, before considering taxes, inflation, or healthcare surprises. With lower needs, say $18,000 per year, you still need $108,000 set aside for the gap alone. The slow start shows up in account balances by age. Under 25, the median sits under $2,000. From 25 to 34, it's roughly $14,000. Median net worth also traces a normal path, about $91,000 by age 35, and around $266,000 by age 65. A home can lift net worth on paper, but a mortgage and other loans reduce flexibility. Liquidity matters when paychecks stop. If most of your net worth sits in illiquid assets, covering monthly bills becomes a problem, even if your balance sheet looks fine. This isn't a doom script. It's a map that shows the gap early, when small moves count most. The practical response is simple. Raise your savings rate above average and redirect real dollars toward assets on a predictable schedule. The next steps show how to do that with specific targets you can hit. So how do you step off the path most people are on and escape the average trap? Start by outsaving normal. If you raised your income a bit and redirected a few hundred each month, how far could you get? The target isn't vague. Beat the typical 6% savings rate and push toward 15 to 20% of your net income. On $3,000 a month take-home, that's $450 to $600. On $5,000, it's $750 to $1,000. That range builds real momentum because it shows up every month without needing a windfall or a perfectly timed market. And the bar is set pretty low. Most people don't know what normal really looks like or don't feel the urgency to change habits. Why isn't 6% enough? Because short-term goals with big price tags crowd out long-term wealth if you're only skimming the surface. A $62,000 down payment, a $26,000 kitchen renovation, and a $47,000 car don't just arrive once. They show up across a few years and soak up cash flow. At a 6% savings rate, those numbers force you into debt or drain what little you've set aside, leaving almost nothing to compound. Pushing to 15 to 20% covers those near-term hits while still funding future you. The trade-offs live where you sleep and what you drive. Housing and cars decide your investing capacity before you touch entertainment or groceries. Downsizing a rental, taking on a roommate, or negotiating at renewal can lower your baseline more than chasing coupons ever will. Swapping a high-payment vehicle for a reliable paid-off car frees hundreds by removing the loan, shrinking insurance, and cutting taxes and fees. It feels uncomfortable because you notice the change daily, but the cash you free becomes the engine for everything else. Here's a simple blueprint. Live on $4,500 instead of $5,500. Redirect that $1,000 difference first to debt, then to investments. This flips your month from cover and cope to fund and grow. You're not squeezing lattes. You're restructuring the floor of your budget, so investing happens automatically, not only when nothing goes wrong. Run the progression in order. Step 1, eliminate any 20% APR debt. Attack it with every extra dollar until it's gone. Step 2, build 3 to 6 months of expenses in a high-yield savings account so one job hiccup or a car repair doesn't send you back to the card. Step 3, Automate investing into low-cost index funds across tax-advantaged accounts first, then a brokerage. That automation matters more than motivation because it removes the need to decide each month. Quantify the upside. Put $12,000 a year to work at a conservative 7% and leave it alone for 20 years. You're in the ballpark of $490,000, with roughly $240,000 of that being growth. The exact number varies with fees and timing, but the point stands. Consistency beats one-off wins. And if you start sooner or add even a small annual increase, the compounding accelerates without extra effort. Strengthen the income side without blowing up your schedule. Add $300 to $500 a month through a narrow skill, small freelance work, tutoring, weekend shifts, or a targeted promotion plan. Channel 100% of that into assets, not lifestyle. It stacks cleanly on top of your savings rate and shortens every timeline. Lock it in with systems. Set automatic transfers on payday. Use a separate checking account for fixed bills so they never collide with variable spending. Turn on alerts for category thresholds so you correct mid-month instead of post-mortem. The payoff isn't just a bigger account, it's peace of mind. You're no longer hoping Social Security doesn't run out of money. You're building your own margin so minor leaks don't sink the plan. From here, tightening one fixed cost can start the shift. Here's the bottom line. Average isn't safety, it's a slow leak. When you fix the leak, compounding flips sides and starts working for you instead of your bank. This isn't about secret knowledge. It's about being more intentional with money than the average person. So choose one lever today. Cut a fixed cost you pay every month. Boost income by $100 with a small skill or extra shift, or automate a transfer to savings or investments on payday. Comment which one you picked and why. If you want data, not hype, subscribe. Be normal or be better than that. Weekly research-backed steps start with your choice today.